The largest car price bubble in history has popped, and warnings are now evident. Yet, the automobile market downturn will intensify further towards the end of 2023, with more cars produced and dealerships getting stocked. The factors that caused both new and used car prices to skyrocket are fading as increasing supply meets customer needs. Even major Wall Street banks alert about the imminent price reductions and their effect on already struggling car dealerships. Lately, they've faced multiple monetary hurdles, notably a spike in vehicle repossessions due to an all-time high in loan defaults. Several elements converge, forming a perilous situation for the U.S. automotive sector, potentially leading to significant financial distress for both lenders and purchasers. We'll delve into this further in the next segment. Before proceeding, kindly support our content with a thumbs up and remember to subscribe to our channel for future updates. Interestingly, as dealerships are brimming with cars, the prices of both new and used vehicles are falling. The U.S. car market is seemingly transitioning beyond a phase marked by stock deficits and price hikes. Recent data indicated that from January to June, the average new car price experienced its steepest drop in a decade. For the year's first half, the average new car price dropped by $865 as per Kelley Blue Book's report. Predictions say this decline will reach $927 by July and will further drop to $978 by August's end. Prices are likely to decrease even more in the upcoming quarters, potentially causing new vehicle prices to diminish by double digits by year-end. Concurrently, used car prices have already seen significant reductions. On average, used car prices have decreased by 16.5% since January, with larger dips expected in 2023's latter half. Cox Automotive points out that this sustained price decline is unprecedented since the boom caused by car stock shortages during the COVID era. The current price drops for cars, both new and used, are highlighted by researchers as some of the steepest in Manheim's records, and the sharpest since the 11.4% dip in April 2020. Over the last month, used car prices decreased by 6%, following a 4.2% reduction in June. This denotes the most significant monthly reduction since the pandemic's onset, when dwindling demand compelled dealers to cut prices. Higher interest rates and increased discounts on new vehicles are dampening the appeal for used cars. This leads to a drop in their auction prices, a platform for dealers to purchase and sell second-hand vehicles. Dealers have also almost fully restocked their used car inventories that had been depleted in 2021 and 2022 due to various disruptions. Recent months have mirrored 2019, the last typical year we've observed, commented Chris Frank of Cox Automotive. Just a year prior, the market observed a wild inflation, with car prices consistently 10–12% higher due to scanty inventory. Michelle Krebs from Cox Automotive notes, currently the market is transitioning from the volatile phase where multiple factors like semiconductor shortages, slow production, minimal loan interests, and consumer demand fueled by stimulus checks inflated prices significantly. According to Cox Automotive's chief economist, Jonathan Smoke, we might see even deeper price cuts in the coming quarter after substantial wholesale reductions in the past 3 months. He emphasized that cars are assets that depreciate, and the factors that propelled their values in 2020 and 2021 are evolving. With retail prices declining for 8 straight months, Smoke anticipates more affordability in the used car segment in late 2023, assuming inflation continues its descent. Carl Brower of IC Cars highlighted that the past inflation surge, especially in the auto sector, was due to excessive demand. But now inflation is causing a decline in used car prices since consumers grappling with increased living costs have restricted car budgets. Higher interest rates, alongside declining consumer purchasing power, are pushing down used car prices. As Brower explained, the elevated interest rates increase the cost of car financing, and persistent inflation squeezes consumer wallets. Dealers, hence, are anticipating more price fluctuations as the year concludes. In a move to revitalize sales, several prominent car manufacturers are implementing significant price reductions across their vehicle lines. A detailed report from Axios highlighted this trend, with brands such as Nissan, Buick, Volkswagen, Fiat, Mercedes-Benz, Volvo, Lincoln, Land Rover, and the electric vehicle giant Tesla, all making noteworthy price cuts. To illustrate, Nissan's transaction prices underwent a drop of $1,244, and the average dip across the vehicle market stood at $1,558 for the second quarter. The EV market in particular has witnessed some pronounced shifts. Among the most striking revelations is Tesla's price restructuring, which stands out not just for the brand, but as an indicator of broader market trends. Electric vehicles, as a segment, have seen the steepest price declines in 2023. Evidence suggests that from January's average of over $61,000, the typical transaction price for an EV descended to approximately $53,400 by June. This downward trend in EV pricing is further emphasized by data from Kelley Blue Book. Their findings suggest that given the current pace of sales, the complete inventory of electric vehicles in the U.S. would take about 103 days to exhaust. This duration is nearly twice the time required to sell the current stock of new, non-electric vehicles, which stands at 53 days. Adding perspective to this, just a year and a half earlier, the inventory levels were only half of what they are now. Examining the broader automobile market, even though the latest vehicles come with a heftier price tag compared to the previous year, the rate of increase has been tempering. For context, in July 2022, the price tags on vehicles were up by 12.4% from the rates in July 2021. However, the most recent data reflects a more moderated increase of just 1.6% from last year's levels. This changing landscape can be attributed to a couple of pivotal developments favorable to buyers. Firstly, automakers are enhancing their promotional efforts, offering better incentives to entice customers. These incentives, amounting to an average of $1,928 or 6.2% of the vehicle's purchase price in July, as stated by Kelley Blue Book, can manifest as attractive financing options or direct cash rebates. Secondly, dealerships are becoming more receptive to negotiations, agreeing to more significant reductions from the listed prices. This change in approach is reflected in the inventory statistics. By the close of July, the inventory for new vehicles expanded to 2.2 million, a notable surge from January's 1.75 million. However, the prospect of a dealership discount doesn't guarantee a smoother buying experience soon. Skyrocketing auto loan rates might maintain subdued demand. For the 80% of Americans who lease or finance their vehicles, a mere 100 basis point increment in interest rates can mean around a 20% surge in monthly expenses for a typical 72-month, $45,000 loan, potentially neutralizing the benefits of lower vehicle costs. Both lenders and purchasers face turbulent times ahead. More U.S. residents find it challenging to meet auto loan payments due to increasing interest rates and steep routine expenses. A concerning escalation in car repossessions could spell financial chaos for both parties. The past year saw auto loan delinquency rates triple, and prime order repossessions climb 13%. Prime loans, which cater to riskier borrowers and often default more than standard loans, can result in significant financial losses for buyers and lenders. Even prime borrowers aren't spared, with their repossession rates doubling. As the grace period from lenders and stimulus initiatives fade, many might find themselves drowning in debt. When examining potential loan defaults and repossessions, specialists look at unemployment rates and household income shifts. The past financial crisis saw a spike in defaults due to increased unemployment, decreased incomes, and dropping home values. A similar situation appears to be dawning, with CBS noting a decline of 585,000 full-time jobs in July, the steepest since November 2020's COVID-triggered loss of 722,000 jobs. House prices in major cities, including San Francisco, are rapidly decreasing, with some witnessing over 20% corrections. Alarmingly, the past decade saw Americans lose nearly 36% of their buying power, with 17.5% of that occurring in the last 3 years. Given these factors, the downturn in the U.S. auto market seems likely to deepen, making recovery a distant prospect. We trust you found this overview valuable. Appreciate your attention.